I'm Teneale.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. So welcome back. Glad you've tuned in for another episode as we have a special guest on today who is highly knowledgeable investment specialist at Vanguard, and her name is Libby Newman. Vanguard is a world-famous index fund manager, and we are very much looking forward to giving our listeners the rare opportunity to gain insight into the investment landscape today. So Libby, welcome. Thank you very much for joining us.
Yes, thanks for having me along today. It's a shame I couldn't be there in person, but next time.
Next time, that's right. So, Libby, before we get stuck into all of the technical stuff, if you could just tell us a little bit about who you are and perhaps about your journey in the investment industry and Vanguard.
Yeah, great. So I've been in the investment industry for more than 25 years now. Probably the last 2.5 years have been with Vanguard. And for 13 years prior to that, I was actually in a research team at Lonsec, which is a firm that researches a lot of managed funds in Australia on behalf of financial planners. So I was mainly looking at multi-asset funds and bond funds in my role there. But yeah, been around the market a while.
Yeah. So, and how did you get into investing, Libby? What sparked your interest in that space?
Probably my dad, I think, initially, because he was an accountant in a country town in Queensland in Dalby. And so he was helping people organise their financial affairs. So probably interested like from a fairly early age. So it's interesting that I've ended up at Vanguard, probably doing what I said I was going to be doing at about 14 years of age. So, yeah.
Wow. So it's definitely one of your passions then. So before you started with Vanguard, you obviously had a lot of knowledge in the industry. Is there anything that you noticed that was different about Vanguard to your previous experience? Did it change your mindset?
Yeah. So I guess during my research years, I was fortunate enough to meet some of Australia's top fund managers and global fund managers, including Vanguard, of course. So I guess you could say it was a 13-year courtship on both of our parts in terms of me sussing Vanguard out and the other way around. So I was fortunate to meet a lot of really smart people in funds management. I have to say that modesty and humility were not always in abundance. So that's probably something that Vanguard has a little bit more in their culture. But even the smartest people that I met weren't going to get it right all the time. But sometimes what they're doing is trying to outguess the other smart person down the street. Also, I guess given that I started my role at Lonsec just in the wake of the GFC, it was also a timely reminder that there's no such thing as a free lunch. If something looks too good to be true, it often is, and simple is can be better.
That's really great, and I think it's always interesting to see where those switches happen, where you get to understand what it is that you truly value. And you mentioned there the culture seemed to be the right fit for you when you came on board with Vanguard. And no doubt there's been lots of learnings that everyone takes from different jobs that we've had over time. What's one of the key learnings that you feel you've had since being with Vanguard? Has there been any?
Yeah, well, I guess when I joined, like I'd always seen from the outside, I guess the Vanguard's mission is to take a stand for all investors and give them the best chance of investment success. And for a lot of firms, you sort of think, okay, well, that's a statement that just sits on a wall or on a screensaver, and it doesn't really, that company, they really live that value day to day. And so it was interesting just coming into Vanguard, and it really does permeate everything we do, all the decisions that we make about our product lineup, about how our stewardship program works. And note on that mission statement, that's about taking a stand for all investors, not just Vanguard investors. And I think the other thing that really resonated with me was, unlike a lot of fund managers, we don't have public or private shareholders looking for a dividend. So it's a little bit like a profit for members situation. We are ultimately owned by our investors, and so our profits are returned back to investors either in the form of lower fees on our products as we build scale, or improved service in terms of giving them tools for education purposes, or just to give them the best chance of investment success.
Absolutely, and that is important, because when you're talking about those stakeholders, there's always going to be a conflict, whether it's real or perceived there, between the various stakeholders. So it's really interesting to see Vanguard's take on that. Yeah.
It's not something that's very common across the. Mostly there's a shareholder who's looking for some sort of return or dividend from their investment, and that can,
It's very interesting, because in structuring it that way, you remove the issue of agency, which is usually always common in any financial institution. Vanguard is an index-style fund manager, and Allman Partners, where we work, have always been advocates of index-style investing since the early 2000s, which was back when the majority of advisors and institutions branded this as a lazy way of investing, for lack of a better term. In today's landscape, the broader sentiment is that, it's much different. So, Libby, can you break it down for our investors what index investing is and why that works?
Yeah. So, essentially, the philosophy is to provide low-cost and high-value investment. So, ultimately, investors keep more of their returns, which is a simple concept but pretty powerful. So, index-style investing means that you're buying a very high proportion of the investments that are available in the market. So in the case of the Australian share market, for instance, we might be buying 300 of the shares that appear in that index. Or in the words of our founder, Jeff Bogle, or John Bogle, depending on which day of the week you look him up, you can look for the needle in the haystack, or you can buy the haystack. So essentially, in an index fund, you are buying the haystack. And over time, the market return is probably influenced more by the winning stocks, which become a much larger weight in that overall index over time, relative to the underperformers, which might become a commensurately smaller part of the index, and even drop out of the index at some point. So actually, the maths works that by investing in everything in the index, you're actually participating in those stocks that are doing better over time, and commensurately less exposed to those that are doing less well. It's actually quite a clever way of investing, and a lot of institutions have actually cottoned onto this and realised that actually it's an efficient way of getting the returns from the market.
Absolutely. And of course, there are different ways to invest, and we often speak to our clients about the two starkly different approaches, one being a very speculative approach, and really its name says it all, and then a more evidence-based approach, which is aligned a lot with what we do at Allman Partners, and has led to the long-term success of our clients, along with some great strategic advice, of course. Now, so Libby, you've spoken a bit about index-style investing, and like you say, it's not finding the needle in the haystack, it's taking the whole haystack. And so if we bring that to some key characteristics of what our clients hear all the time, they hear, don't put all your eggs in one basket. And that's a key area here, lots and lots of diversification. You mentioned another being the fact that you can offer products at a nice low cost, because we always say to our clients, look, if you're not having to go chasing extra return because you can get those costs lower, that's a benefit to you. Now, obviously, there's a different the other side of the fence sits over there, and you've been exposed to that world as we all have at some point during our careers, which is that speculative approach. Can you give us your thoughts and commentary around the differences between those two and what you see in that space?
Yeah, well, I guess I see that investing is a long-term approach. The returns from investing in successful businesses, it requires discipline and a degree of patience, because from time to time, given that these stocks are valued on the stock market on a daily basis, sometimes the value of those businesses goes up and down for reasons on the stock market that may have nothing to do with the day-to-day operations of the business. But over time, investors are rewarded by growth in the value either of those stocks, or by payment of dividends, or by both. To me, the speculative more aligns with picking what is going to happen with the price of that particular business day to day. And so identifying a few businesses that they think might do better than everyone else. And so for that to work, you've got to pick the outperforming stocks, and you've got to assure that the proceeds of your winnings essentially outweigh the cost of finding them, because doing that research and at a very deep level, is not free. And then you've got to ensure that you've got a higher weight to those more speculative stocks that might do a little bit better and maybe it's only over a short period of time relative to the rest of the market. So, essentially investing is something that requires discipline and patience. Speculation requires a degree of confidence that you're going to be able to be smarter than the next person, and that is going to deliver you additional returns over what you would probably be getting from the market anyway.
Absolutely. And I think you hit on a couple key points there. So we often speak about the fact that, speculating is it's like gambling with your money. You're taking a punt that something's going to do better than all the other information that's out there telling you that if you just held the entire market of assets and you took a long-term approach, that you will be rewarded for that in terms of getting those good steady long-term returns. So this is some of those things we speak to our clients about, that speculation carries with it a huge amount of risk, and really do you want to be exposing your key capital, which is there for your goal funding, to those areas. So if we come back then into index investment, I want to talk a little about a comment that Warren Buffett, obviously a very famous name in our field, he made in one of his annual reports from Berkshire Hathaway, his investing business, which was back, 2013 now, so talking a decade ago, but it still resonates very well now. And he actually said, and I'm going to read this out, that my advice to the trustee of my estate could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard. So he actually named Vanguard at that point in time. Yeah. And I believe the trust's long-term results from the policy will be superior to those attained by most investors, whether that's pension funds, institutions, individuals who employ high fee managers. Now, I guess a lot of people know Warren Buffett is one of the most, if not the most successful investors of all time. So that has something to say about how powerful index investing actually is and can be. And there are a number of index fund managers out there in the marketplace. So what's one of the key factors that investors should be considering, Libby, when they're trying to find, which fund manager to use?
It's interesting. Your anecdote reminded me of a wager, or essentially a bet, that Warren Buffett also had with a hedge fund manager around that time, I think, which is essentially, I think at one of his annual general meetings, he pitted a Vanguard fund, I think the S&P 500 index fund, against this hedge fund manager, who said, "Look, I can easily get you better than the index fund over time, because I know where the best hedge fund managers are and what they're likely to do." And I think the bet lasted about a decade, and there was periods of time when maybe Buffett was looking a little bit worried. But what he knew was that over time, that noise and churn are probably the enemy of your longer-term return profile. So ultimately, I think he invited our founder, Jack Bogle, to one of his meetings at the end of that bet. When it was ultimately successful, the index fund had outperformed that handful of hedge funds over that decade. In terms of the question about considering what to look for when finding the best, well, I guess the first thing is probably not all indexes are created equal. I think ETFs, exchange-traded funds, have been quite popular in the last couple of years, and we've seen, I guess, many different flavours of ETFs come to market, and they track indexes which are the less traditional indexes, like they might be geared towards the latest thematic around artificial intelligence or the like. And oftentimes those thematic indexes are launched when that part of the market has done quite well, and so that they attract a lot of attention. But we would advise that chasing performance is not recommended, because often that might result in investors buying into something that is at the peak of its hype, and ultimately you might end up buying high and selling low, which is the exact opposite of what you want to be doing in investing.
Absolutely.
And I think the other thing to note is that index managers will try and track the index they're managing as closely as possible, and to some degree they're looking to overcome and deliver back on some of their fees that they're charging, albeit that oftentimes they're low. They're looking to overcome some of the fees that are managed for that management. And so they do undertake some incremental value add activities, which mean that, in effect, sometimes you're getting some types of funds pretty much for free, because the value add activities sometimes cover the cost to such a degree that you're tracking the index for virtually no cost at all, even though the headline rate might be 7 or 8 basis points. So, so there is a lot. People sort of think that, as you said at the outset, index fund management is lazy, but there is a lot of work that goes on under the hood in terms of delivering value back to clients, especially as you build scale.
Absolutely. And, like you say, there's a lot of different labels that put index on it out there. And, the idea that index just means that I'm buying the whole market is often not the case as well too. Even if an investor thinks they're buying all of the Australian Stock Exchange, they might still only have a small quadrant of that, because that particular fund manager is looking at a small cap index or whatever the case may be. So there is a lot of research that investors have to do even to understand what those underlying assets should look like there.
Yeah, and that's where the likes of Allman Partners can help out, I think, because, you can help to unpack. There's a myriad of things that are available out there now for investors, and you can just help that bring that together for your clients.
So, Libby, is there anything in particular about Vanguard that makes it stand out in the index world?
Well, probably apart from the ownership structure, which I've already touched on, I think that's relatively unique. We are one of the larger fund managers in the world, so certainly that benefit of scale we do bring to bear in a lot of our products. And probably, again, coming back to that mission statement, we do look for each of our products to stand on its own merit. So we're not cross-subsidising products, essentially using the profits that we might be having from one particular style of investor and product. We're not cross-subsidising those into other styles of products. It really has to stand on its own merits, which, when I look across the landscape, that's not necessarily the case across the board.
Yeah, absolutely. And thinking about different styles of investing, we can't be sitting down with you and not talking about ESG investing. So for those that don't know, environmental, social and governance factors in the investment space, it's a really hot topic at the moment, and it has been for some time now. I'd be interested to hear, Libby, what your thoughts are on ESG investing.
Yeah, well, I think it's been encouraging that as a whole, I think the funds management community probably over the last several years have really lifted the bar and continue to lift the bar in how they're tackling ESG. At Vanguard, I think we're tackling it in a few different ways. There's an avoid, so we have products that are essentially excluding typically the types of sectors that people may not want to provide financial support in by using the funds. So we have what we call exclusionary funds. We also, given that we're one of the larger managers around the world, we also engage with companies directly. So we have a seat at the table in terms of, company voting and voting at company meetings on issues of climate risk, social and equity issues within workforces for different types of companies. And so we really I think we've more than doubled the size of our stewardship team, who do a lot of this work in terms of sitting down with companies and discussing with them directly how they're tackling climate risk and other social and equity risks within a company level. And then lastly, so we've got avoiding those sectors, engaging with companies, and then allocating. So we do have other products that target specific areas of investment which may have a greater impact on social or environmental issues. We've got what's termed impact investing funds as well. So I guess we're looking to tackle a number of different ways, because we understand that everyone has different individual values and preferences, and we're trying to meet the needs of all of those investors by carrying a range of different products, hopefully to cater to those needs.
And for investors, this space is a particularly interesting one because ESG is, as we know, has been a label that's been slapped on a lot of different investment products in more recent times to to make them look attractive. And for investors, it's important that it lines up with their values. And if they think, I don't want to be investing into something that generates revenue from tobacco or from child labour or from whatever the case may be.
Exactly.
There's such a, again, it's where those investors need to dive in and have a look under the hood and go, well, what policies is this fund manager actually employing that I can be assured that I don't have the exposure there, or I'm okay with the level of exposure that might intrinsically be there, because as we know, some things can't just be completely stripped out of a portfolio. Yeah.
Yeah. And also because we're managing, a lot of our products are traded either in an ETF format. So we do provide on our website a listing of what is exactly in the portfolio, so the exact holdings that are in there, which I think that transparency helps people understand what things might be included or excluded from funds at a better granular level.
Yeah. And Libby, have you seen that there's been a huge uptake of ESG investing, and does this kind of influence where you see the thoughts of the future of this landscape going? Is it going to become more of a must-have in investment portfolio?
Yeah, it's been interesting. So I guess there has been a lot of take-up. I think, one of our Australian shares exclusionary funds has been quite popular because it has catered to a lot of the things that people are looking for. So we have seen an uptake in, I guess, ESG types of funds. 2022 was probably an interesting test case because from an investment standpoint, a lot of people were also looking for something to hedge against inflation. And a lot of times those inflation hedges were coming through in the forms of exposure to commodities or energy-related stocks, the exact type of stocks that someone in an exclusionary portfolio may not have. So there might be years when I guess there's some trade-offs to be made from a return perspective, but ultimately I think we see that over time there tends to be not a huge difference. And I think given that we're seeing an uplift across the board in terms of ESG engagement at the company level and at the product level, I think that there will continue to be support for this type of investing going forward.
Yeah, absolutely. And you'd mentioned there that, in times of, when COVID in 2020, when all of that started happening, and it causes a lot of unsettlement in people, and we've got high inflation, increasing cost of living and all those things mixed in together in one bag. And there might be some people out there at the moment that go, it's probably not a good time to invest. Everything feels quite scary and we're not too sure where it's going to head. Libby, can you give our listeners some food for thought around that type of mentality?
Yeah, well, I think every year that I've been in the financial markets, there's been someone saying that this year is more uncertain, or there's more volatility, or there's likely to be more volatility. So I think that's a pretty much permanent feature of the investment landscape. I guess the truth is that the future is unknowable, but the long term is inevitable. So the magic of compounding, which is really what you're tapping into as a long-term investor, is the magic of compounding is your friend. So it's really more about time in the market and getting that investment going early or by regular contribution, which really helps to build wealth over time, not timing the market, timing the market, because that can be notoriously difficult to do. So essentially, the sooner you put your money to work in investing and get the benefits of compounding, the better off you'll be over the long term.
That's exactly right. Yeah,
I think that's a really good space to enter into, because we have a lot of people that are talking about starting investing. Maybe they haven't started their journey at all yet, and they're not sure when to get in. So your commentary there about the fact that being in the market for the long term is a better scenario than trying to time when to get in and when to get out. That's a key point. So the earlier people can get invested, the better that long term outcome is going to be for them. What do you think about the idea of how much is enough? The common question we get a lot is, I don't feel like I'm ready to invest yet because I don't have enough money. And I feel like Vanguard's quite inclusive in this manner. So what are your thoughts there, Libby?
Yeah, well, I think it's been good that over the last several decades we've seen essentially the democratisation of investing. And what I mean by that is that it's become much more accessible for people to sort of start investing with a much lower base capital amount. So maybe using a couple of $100 and then just sort of chipping in on that regularly. So this is a conversation that I have with my 20-year-old son. We do have some different opinions about what constitutes a diversified portfolio, because his diversification might include some cryptocurrencies and some NFTs or something. I don't view those in quite the same way from an investment perspective, but I think that's a lesson that best learnt earlier in your investing career. But you don't actually need a big pool of money to get started. Some of our already mixed diversified funds, which basically you're tapping into 16,000 different securities, and you can essentially have exposure to that in a single trade. I think it's around $60 for one unit, or start with an amount of maybe $500 on our platform and set up a regular couple of $100 investment amount. So, you really don't need a lot to get started, and it's about getting started and just getting the benefit of that through time. Which again, tapping back into the earlier comment around my dad, I think gave me a book from Noel Whittaker. I think I was around 18 or 19, and I really wished that I had done what was said in that book in terms of just getting into the market much earlier and just letting that compounding take effect. And I think that's another comment that Buffett has made, that you don't necessarily need to be the smartest person in the room to be successful investing. You just have to live long enough for that compounding effect to really magnify your returns over time. And Buffett's managed to do that. He's quite an old guy. Yeah.
Oh, okay. Well, thank you very much for your time today, Libby. I think that's been a really great conversation, and we definitely appreciate you taking the time to speak with us. For everyone that's listening, hopefully you've enjoyed the podcast today. So if so, please don't forget to subscribe to the show and, of course, leave us feedback. We want to hear more from you, so we can give you the content that you want to hear. So join us again on the Wealth Experience podcast, where we talk about all things health, wealth and happiness.
The mention of any specific investment products, companies or services in this podcast does not imply endorsement or recommendation. We encourage you to conduct your own research and due diligence before engaging in any investment activities. ESG stands for environmental, social and governance. Whilst there is a general consensus on the broad categories encompassing ESG, it is crucial to note that different organisations, institutions and regions may have varying definitions and interpretations of what falls under each category. Therefore, there can be discrepancies in how ESG factors are assessed and classified. Investing in securities, including ESG-focused investments, involves risks. The value of investments may fluctuate, and past performance is not indicative of future results. We encourage you to carefully consider the risks associated with investing and seek professional advice if needed. You should consider your objectives, financial situation and needs, and the relevant product disclosure statement and/or IDPS guide before making any investment decision. You should also refer to the target market determinations of any product before making an investment decision.